it really demonstrates how portfolio managers and the institutional investment community has been focusing on these large caps, and these small caps are starting to get cheaper and cheaper, starting to get a point where you can get a good margin of safety out of investing in them. And then hopefully, if these companies execute, your upside will be a lot higher once that institutional capital starts flowing back into the small cap space.
Hi, everyone. My name is Cam. I am the CEO co-founder of Investapal. I think we're back with episode 6 now of the Investapal podcast. I am welcomed by Nicholas and Ben from Atrium Research. They are a small cap research firm out of Toronto. Guys, welcome to the show.
Thank
Thanks,
you,
Cam.
Cam.
So to kick things off, you guys are obviously positioned around small caps. I think it was an interesting conversation to be had. I was doing some analysis before the show. If you end up looking at the Russell 2000, so an index of U.S. small cap stocks versus the S&P 500, it's at an inflection point that it appears for the next year or so, small caps should outperform larger caps. I think if you saw the recent rally, we've been very much concentrated around the S&P outperforming in general. And within that sleeve, there's only really been like 5 or 7 stocks that have led that outperformance. Since then, over the past few weeks, that breadth has been expanding. So there's been more smaller cap, still mega cap stocks, but not the Nvidias of the world that have really been rocketing. We've been seeing that breadth expand now. I'm curious, as we see more breadth participation in the market, a poise of small cap stocks starting to outperform. What's your outlook on that?
Yeah, for sure. So I guess kind of the way we think about things is not timing the market, trying to get in when small caps been underperforming or relatively overperforming. Is we try to find companies that are undervalued right now, regardless of kind of the macro conditions. And what we're finding is that there's tons of small cap, micro cap companies that are trading at fractions of the multiples they were trading at a few years ago based on historical standards, as well as comparing them to their mid cap peers. And as you said, I think I was looking at a graph a little while ago, and it was saying that if you take out the top 10 companies out of the S&P, the S&P is actually flat over the last couple of years. So it really demonstrates how portfolio managers and the institutional investment community has been focusing on these large caps, and these small caps are starting to get cheaper and cheaper, starting to get a point where you can get a good margin of safety out of investing in them. And then hopefully, if these companies execute, your upside will be a lot higher once that institutional capital starts flowing back into the small cap space.
Why do you think that, like historically, the value camp over the past decade hasn't really worked? It's been very much like a growth story. So, like, why do you think in particular that there should be a focus on these companies trading below a discount, and like why that would be attractive to an investor? Like, what's different?
For sure. So I think that it kind of comes in phases, growth and value, right? So if you look in a deeper history, once you go back 50 years plus, then you'll start to see where value starts to take over. And yeah, we've been in a world where rates continually go down and money got cheaper and cheaper, and these growth stocks are obviously the beneficiary of that. But now we're starting to see things where the economy's slowing, rates are higher, and that starts to become an environment where these value stocks can start to outperform the growth, in my opinion.
Okay, interesting. So within the small cap sleeve, then, is there specific sectors that you think are uniquely positioned to outperform, especially with where the rate market is right now?
Yeah, I mean, I'll hop in just on my side of things. I'm the mining analyst at Atrium Research, and I'll speak from a mining perspective. And Nick mentioned there's been cheap money for the last couple decades now, and that's caused people to dive into these, the tech industry and these high growth names, and um, away from the mining sector, and that's where you're seeing the multiples on the mining companies, both from the producers all the way down to the juniors, compress and contract, and right now we've seen so much lack of investment in the mining and metals space, and this has caused a little bit of a dislocation on the supply and demand side of things. So we think, for the next decade plus, we're going to see a lot more money start flowing into the mining sector. Um, those multiples, if they can even get back to a historical average, that's multiples on where the stocks are trading at right now. And then again, just on the supply side, there's been such a lack of investment over the last 10, 15 years that that's going to cause a big supply and demand gap. And ultimately, the commodity prices, whether it's precious metals or commodities like copper and some of these electric battery metals, ultimately those prices are going to increase dramatically. They've already started. And that's where you'll see the investment come into this market a little bit more. I can only really speak on the mining side of things, but I imagine there's some similar cases on the special situations or more diversified side that Nick covers.
Yeah, for sure. I think mining has been a focus for our research, given that we're potentially entering a super cycle that could last 5 to 10 years. But yeah, we're finding value in other pockets of the market, especially kind of these growth stocks that have sold off pretty drastically over the last year's rates have increased, and the small cap market's been decimated. So we're pretty agnostic as to where we find value, but um, I think there's some good value in stocks that have been beaten down over the last few years.
Within the mining sleeve, do you guys have a particular tilt on like precious metals versus like base commodities, especially after, the market sell off, and it seems like we are hitting a soft landing right now. So like we should see a resumption in economic activity, like what your thoughts are on there and where investors could position.
Yeah, I mean, I think there's sort of two sides to it. Specifically on the precious metals side, it's very difficult to have a fundamental opinion on where the prices of those metals may go. You can talk to all these different bulls and such, and they think it's going crazy. Um, Gold has done very well in the last little while, and again, the gold miners, and in particular the juniors, are trading at you know multi-decade lows. So there is an opportunity there, but for myself and the general investor, if you're looking for a little bit less of a risky play, it's very easy to get behind the value of copper companies, silver companies, some more base metal miners. And the reason there is, like you said, the world's growing. It's been growing for the last little while. There's been a lot of underinvestment in the mining and metals space, specifically the commodities, for a long time. And that supply demand gap is growing, as I mentioned. But then also, you've got the electrification of the world as a tailwind for copper and some of these different battery metals, where that demand backdrop is growing by the month, by the year, and is going to continue to grow for the next few decades. So just looking at from a bird's eye view, it's very easy to get behind copper, nickel, and metals like that, where the demand backdrop is so significant that you can justify a higher price, a year from now, 2 years from now, and ultimately 10, 20 years from now. So I definitely like the copper space in particular. There's some, large cap mining companies out there that pay great dividends, that mine, these commodities, base metals, copper, etc. So you can get a pretty high dividend, but also take part in what we believe will be large price increases over the next couple years and into the next decade.
Do you guys focus in on like there's a lot of conversation now around rare earth metals, a lot of like wanting to onshore that back into North America without the reliance on China anymore. Do you guys cover any of those names?
A little bit. It's a bit tricky of a market for sure. One metal in particular we know fairly well is manganese. So this is a metal that is a component in batteries. Right now, there's little to no, and I'm pretty sure there's no North American production of manganese right now. Um, and so again, that's a very large risk to the U.S. economy and the Canadian electric battery market. But the big thing there is just that it can be a supplement for lithium in the makeup of these batteries. We've seen the lithium price do really, really well over the last few years, and it's expected to stay elevated for a while. And so that's where these substitutes come into play. Manganese can be one of those substitutes. There's a lot of different articles and even battery manufacturers out there saying that they're raising the percentage of manganese in their batteries because it's a cheaper alternative. So manganese is a good one. There are a couple exploration companies and development companies in North America that are working on, bringing that production online. But ultimately, time will tell where those prices go. We think it's up, and a North American producer will do very well in that scenario, especially given there's very little competition on that front.
Yeah, especially with the need to buy American now.
Mm-hmm, for sure.
So, Nick, anything on your radar, small cap wise, on like where investors can end up focusing on a special situations viewpoint?
Yeah, for sure. Um, yeah, a piece that we worked on recently, we do a lot of thematic research into interesting themes and such, and one that's performed really well is the restaurant royalty equities in Canada. So, what these guys do is they take a percentage of total sales for restaurants in Canada. So, Pizza, A&W, Boston Pizza. There's a couple other ones. And we've done some good research on this space, and what we've kind of found in our thesis is that if inflation does start to continue, and it's started to come down, but even if the new range is 3% rather than the traditional 1 to 2, that can be a tailwind for them because they're taking a clip on sales rather than net income. So they'll have that tailwind for a number of years, when in the past it's mostly been driven by foot traffic and increasing stores when those factors are happening. But with the inflation, which we think will continue and will come in waves, now we're kind of on a down wave. These guys, since they're taking a percentage of sales, it's going to be a new tailwind to boost that same store sales growth. And the stocks are still trading at pretty cheap levels by historical standards, and their dividend yields are great at the time. You're going to get about a 8 to 9% yield.
What sort of, can you talk about a name in particular?
Sure. So the best performing one in our view has been A&W. They've had the most consistent sales growth over the last 10 years or so, and they've kind of opened the most amount of stores inorganically, and then organically increasing foot traffic, increasing customer basket size. So they've done really well. They've been the best performing in the group. And yeah, so what we kind of peg it to is we'll look at what the food inflation was in Canada. I think last quarter maybe it was 6 or 7%, and we'll compare their sales growth to that, see if they can actually outpace that. And A&W's has tracked along pretty significantly. Some of the other peers, like the Keg and Boston Pizza, have that kind of boost from returning levels of foot traffic from COVID, and they've actually even outperformed inflation. So they're getting that boost from the food inflation, the price of food going up, but they're also getting additional revenue from foot traffic, COVID being over, and then that combined creates a new same store sales growth figure that was greater than it was in the past. So I think as a basket, they're all pretty good. A&W's been the best performing one, but as a consequence, it trades at the most expensive multiple and has the lowest yield.
That's an interesting name because, I was living in Nova Scotia for a bit, and there were way more A&Ws than there were McDonald's or Subways.
Hmm.
But then you come back to the Toronto area, and that's not the case. And then I know A&W has a bad rap in the US. I'm curious, besides the inflation tailwinds, are they doing anything else that's different than you think a McDonald's is on why they're being able to win out so much?
Yeah, I think maybe their brand has started to help. They brand themselves as a Canadian company, so that must help out in terms of when a Canadian makes a choice. They have numerous partnerships as most fast food brands do, but that's been the way the consumer preferences have shifted. But even if you look at it on an industry level, where QSR sales have gone over the last 20 years, every single year it continued to increase, and that's obviously based on immigration into Canada, increasing population, and then in addition opening new stores and increasing those basket sizes as well.
Okay, very interesting. So I guess, if we could take a step back from this, if we're focusing more on small caps, like the strategy behind a large cap investment thesis can be very much around like momentum or growth, where like I can own like an index fund. That index fund is going to go and invest into these mega cap companies. I don't really have to worry about them. Obviously, on a small cap basis, there's a bit more risk. There's a little bit more research I need to do as an individual. Ben, throwing it over to you, what do you think is like important considerations for an investor to focus in on in their research for small caps
Mm-hmm.
specifically?
Yeah, I think there's a few things. Of course, the industry that they're in, you need to believe in and think that you're on the right side of that trade. But more importantly, especially when you get into these smaller caps, um, you know, beyond the business model itself, Nick and I have realized this time and time again over the last few years is you really got to look at the makeup of the company. So that's the management team, the capital structure, um, and and within those, there's different things you want to look at, and so just with the management in particular, you want to sort of see have these managers has the CEO done something like this before, where they've grown a small company, um, and maybe sold it or moved on from that role once they got the largest sort of multiple on their investment or their for their shareholders, quite frankly. Um, so past successes, takeouts, they grew companies, they've moved on, they want to start at the bottom again and regrow a smaller cap business. Um, Ownership in that company from management is another important thing. So, do they have their money where their mouth is? Right? Are they just taking a salary, or will they actually benefit by the company doing well? I think that's a really big one. As of course, they're going to make the best decision they possibly can for their shareholders if they are a shareholder themselves, and how to sort of leverage the different aspects of the business to create the most value for shareholders. Um, and then relationships is a big one within the management team. Are they connected to people that can raise capital for them? Are they connected to people that can market the business and the stock really well for them? Um, and that goes down the line for a different, it depends on the business and where they are and what industry they're in, but are they well connected in that industry? That goes with the board members or people that are on the management team themselves. And then the other point I mentioned there was capital structure. So, um, you know, we sort of take a look at these companies. Um, when are they raising money? Are they giving up a full warrant versus a half warrant or no warrants when they raise money? How many warrants are there? At what price? We've seen warrants can have a very negative effect on these stocks as they try to break through these different levels. There can be what there's called as a warrant overhang. Liquidity is a big one, and we drive that a little bit through our business at Atrium as well, is that the liquidity needs to be growing and at a certain level for large asset managers to be able to take positions. The liquidity isn't there. Um, they won't invest from a risk standpoint. The stock can, drop very significantly if any major shareholder wanted to get out. So you want the liquidity to be at a certain level and growing. And then also just the makeup of those shareholders. So how many, what percentage is retail, what percentage is institutional. Having institutions is important because it shows that these large, very sophisticated investors believe in the story. They've looked at the fundamentals with great detail, but also, the retail crowd can draw some of that volume to the story, and, like you said, bring some momentum to the stock. On the back of press releases, whether it's well, I guess just on the back of good news, the retail community can really drive that initial volume and then attract those institutions to really get the stock moving. So
So,
those are two big things that are, again, from a bird's eye view, you wouldn't think to be too important. But with these smaller cap names, they, if anything, can be the most important aspect.
so to dive a little bit more into that, like the first part of your answer there around the management team, their ability to execute and their connections. Like when you guys are doing your research reports, are you like going on their LinkedIn and scanning like who their industry relationships are that they're able to tap into? How
For,
can I'm just trying to get at like, how can a retail investor try to pick apart that a little bit more?
Yeah, well, I mean, speaking for let's say the CEO in particular, um, the management bios are on the website. They're in their different filings, they're in their deck, and so on. And so you can get a good idea of what they've done in the past. Is it their first time as a CEO? The risk might be a little bit more with someone like that. If not, what companies, what industries is the same industry, and what sort of size of these businesses that they previously ran were. Did they grow them properly? You can sort of dive into that a little bit. But again, just from taking 5-10 minutes to look at the different managers of the company, you can get a pretty good idea if these people have a good track record or a very small track record or of experience. And then in terms of relationships, I really would look at the board because most of the time, especially with small caps, the management team is picking their board members. And most of the time, they're picking people that they know or are affiliated with in some way. So they have a relationship with them. And most of the time, when you're looking at a board, you want the board to tick off um, the boxes of important needs that a company needs. So can someone help raise the money? Are they well connected in the capital markets on Bay Street in Toronto or in New York or where else? Um, Speaking from a mining company, do they have a couple people that have grown and built mines in the past that would be a valuable resource for the CEO to go to ask, a second opinion? So things like that, and that's where you build this sort of tree of knowledge to ultimately make the best decisions for the shareholders as well as the business.
Okay, interesting. And then so like on the liquidity side too, because if you have an e-liquid stock, to your point earlier, there can be a lot of volatility involved with any shareholders exiting. To increase that liquidity, oftentimes they have to do subsequent raises and then dilution comes into effect. When you guys are researching a company, is there anything, so is that like typically something you look to as well? Like what is that company's pathway to increasing liquidity? How many subsequent rounds raises do they have to do? And like what is the dilution effect on the current investor base?
Yes and no. I mean, I wouldn't say the liquidity is going to be a make or break thing for me. Um, though it depends on how your risk tolerance, right? If it's a very liquid stock, it's probably relatively new. It's probably not very well known across the street in the investment community. So there's a lot of different things that go into it. But again, typically you want to get into a story if you really want to get the most bang for your buck, into a story that's not well known but is developing into a story that will be well known. So again, speaking from my experience in the mining industry, it could be a junior explorer that has some hints of a big discovery, but they're not quite there yet. You get involved there where the liquidity is very low. And then all of a sudden they put in that drill hole, they find that big hit in the stock. That's where the liquidity comes from. Stock goes up, they can raise money at a little bit higher of a level, put that money into the ground, drill more, and the story develops from there. But that can be the same thing with different milestones, different developments with any type of business.
Yeah, for sure. I think something to remember is that if you're right and the management team executes and the business executes, that liquidity will come and you'll have an opportunity to exit your position. So maybe right now the stock's not too liquid, but if everything goes as planned and your thesis was right, the stock will be very liquid and hopefully start trading at an appropriate multiple.
Okay, so if anything, like preach patience then. You need to, if you have a conviction there, it needs to be one where you're able to hold that stock over potentially over a year rather than like trying to make a quick trade off of it.
For sure. And in the small cap land, everything gets delayed, whether it's launching a product or an announcement coming out or management problems. There's a lot of things. And since they're such small companies, there's not as many eyeballs on them. They get a lot more leeway in terms of delaying these announcements and progressions and checking off those check marks on your thesis. So you have to have that patience, and you have to know that you're in it for the long haul. And that's when most of the returns will be generated.
Do you guys
Yeah,
ever look at like the pathway? So obviously like the exchange that you're listed on as well has an effect here. And if you're getting initially listed on like a venture, like the TSX venture or the NEO or the CSE or OTC in the US, is that a consideration as well that they have a pathway to graduating to a more recognized exchange that can accommodate that sort of volume as well?
Yeah, I think it's a small consideration. I mean, we've seen it countless times. Companies graduate from the venture to the TSX, and the liquidity doesn't explode or increase too drastically because I don't think there's that many funds that only invest in the TSX and are restricted to that. So it's something to consider, and it is a small catalyst that can happen, but I wouldn't, base your whole investment around that.
Okay. So I guess Nick, throwing the question back at you, for an investor doing a retail investor doing their own diligence on a small cap company, is there anything you like to focus in on besides management team liquidity?
Yeah, so those are the main two I would say, and then the third one would be valuation. So in the small cap land, I think that valuation matters a lot less when compared to doing research on large caps. For the most part, all of these small caps and micro caps are very cheap, and I would focus your research on not overpaying, not buying whatever stock is the flavor of the month, rather than trying to find which stock is the cheapest, right? Because there's a lot of value traps out there as well. So in terms of how we do things, pretty traditional. You can use a DCF, EVD, EBITDA evaluation, or more industry specific like Ben does with PNAVs and EV per ounce. But I wouldn't base a lot of your analysis on what multiple is trading at. I would focus your attention on what the story is, what the catalysts are, what the company's going to do over the next couple of years, and that multiple will come over time. Just because all these things are cheap, and trying to find which one is the cheapest is just a game that doesn't result in creating any returns.
Okay, interesting. So would you say like taking more a macro approach, like I think these are some key themes going forward in the market, and then diving into some specific areas that can capitalize on those themes, and then some specific names that are uniquely positioned to benefit the most from those tailwinds?
Yeah, I think that's a good way of doing it. We often do top down research, but don't restrict yourself to doing that. If a good company comes across your way and that's not in one of those specific themes you're investing in, you can also find value that way as well.
So is there any specific name that you are very bullish on right now?
Sure. So the first one I wanted to talk about was a company, Yerbay Brands, that we recently initiated on about 4 or 5 months ago, and the ticker is YERB.U on the venture. And what these guys do is they produce a plant-based energy drink that has no sugar and 0 calories. So it's a recent listing. They at least listed on the venture back in February. The stock's done really well over the last 8 months or so. It's about 120 million market cap right now. So these guys have grown pretty rapidly. Over the last couple of quarters, they've been consistently doubling their revenue. Last quarter, they grew about 130% year over year, and they're just growing their distribution base throughout the U.S. So they're at about 12,000 doors right now. So they have all the major ones: Costco, Walmart, any major chain you could think of. They're getting into all those stores and growing that distribution. And what we look at is that there are about 350,000 possible locations that they can get into compared to the 12,000 that they're in right now. So there's a lot of white space for them to expand into. And they're doing it alone. So they don't have a major distribution deal like some of their peers do with Coke and Pepsi. So great growth, great opportunities for further growth. And then going back to management, we really like the CEO. It's a guy named Todd Gibson, and he's been part of multiple beverage success stories in the past. So he was one of the first employees at Monster, which was obviously a massive success. He was also part of Sobe, which was eventually acquired by Pepsi. He was part of Fuse, which was NOS, was their brand, and that was acquired by Coke. And then he worked for Coke for 10 years. So he's a well-connected guy in the beverage space, has those key relationships, and also has a significant position in the company. So all those factors that we're looking for in terms of management.
So I'm no beverage expert, but I am aware, there's been some strategies like Body Armor or like Prime, like Logan Paul's
Mm-hmm.
brand, where like you really need like a brand deal, it seems like, to kickstart that. Do these guys have something similar like that going on?
Yeah, so most of their marketing efforts are focused around CrossFit. So they have partnerships with specific events and specific athletes in the CrossFit space, and that kind of puts together the two worlds of, being healthy, having an all natural drink compared to all these chemically enhanced drinks that have sugar and such, and then pairing that with fitness together has allowed them to grow that brand in that sphere of CrossFit athletes. Um, and yeah, we can see that expanding to other sports as well, as this kind of vegan movement and better for you product movement continues to pick up steam across the globe and help them develop that brand into something that will catch the attention of a Coke or a Pepsi or a Monster that want to acquire their way into that space.
So their strategy then, you think, is to get acquired by one of these big brands in a few years?
Yeah, I think they're a good takeout target. I mean, when you look at the beverage space, there's acquisitions that happen every year. And in addition to partnerships and people using each other people's distribution networks. But yeah, so we've seen countless acquisitions in the $100 million to $500 million range by Coke, Pepsi, and the likes. And this is where we can see Yerbay kind of joining one of those portfolios. And it obviously helps that Todd, the CEO, has sold companies to both Pepsi and Coke and has worked at Monster in the past.
Yeah, okay. Very cool. Do you guys have another one that's worth chatting about?
I've got one on my side, and I know, we spoke about the investment period maybe being a year, a little bit longer. I think the last 5, 10 years might have changed people's opinions on investment timelines, just because, you could make money by investing for 3, 4 months and do well. But especially in the mining industry, it can take multiple years. And quite frankly, some of my best investments personally, I've been holding the stock for 3, 4, 5 years, even, I think, on one of my largest positions. And um, again, if you have the right management company, um, or management team, excuse me, and the right business, uh, there's no reason to sell as long as they're going to continue to grow that. So with that, this is a gold company. It's Canadian. However, they have their operations in Guyana. Its name is Omai Gold Mines. It's listed on the TSX under the symbol OMG, like oh my god. Hopefully, I can say that about the share price one day. Um, but nonetheless, it's a great business. They've got an asset that was historically mined. I think it was about 15 years ago. It was in operation. They mined 3.8 million ounces over a 13-year mine life, and they're looking to do the same thing. So with that, it minimizes a lot of risks in terms of getting back into production. They already have the historical data on that type of resource, very high recoveries. They already have a relationship with the government, so on and so forth. So the path to production is a lot easier than even in Canada, which would be considered a great jurisdiction. Guyana is very supportive of international investment, and that's through ExxonMobil has been bringing in hundreds of millions of dollars in tax revenues over the last few years, and that's only making it more of an attractive investment from an international standpoint. But back to Omai in particular, they have 3.8 million or 3.7 million ounces right now. They're still trying to grow this resource a little bit more. However, they've just recently decided to pivot more to producing economic studies and showing the true value of the asset. So they're proceeding to a PEA, which is a preliminary economic assessment, where they'll essentially put the numbers around how much money this asset can make um, on the back of that 3.7 million ounces that I mentioned. In terms of where the company is valued right now, it's what we would consider dirt cheap. It's trading at about $3 per ounce. gold in the ground. This is a fairly common way to measure the value of a company before they have these economic studies out. But that compares to its peer group, which trades at about $16 per ounce. So a fraction of the peer group, and they're progressing towards these economic assessments. So that's where these catalysts will come over the next few years, showing the true value of that asset, and ultimately, I think they'll reward shareholders with that, given, like I said, all the risk mitigation by having this be a previous operator. In a country that's very supportive of mining, the permitting process will be very quick, and ultimately will show the market that this mine can be back up and running in no time, given that they had already mined close to 4 million ounces in the past.
So back to a point I think you said earlier where, you want the management team to have a strong ownership base of that company. And I know from my time as an analyst as well, gold companies haven't done the best job of returning value to shareholders. Is the management team here aligned to increasing the share price?
Yeah, for sure. And that's a good question. This company in particular has had a little bit of a management overhaul over the last, I think, about 3 years. There were some issues in the past. They've cleaned house for the most part, and now everything's sort of back up and running. They're heading in the right direction. And yeah, Elaine Ellingham, she's got a great geological background. She understands the rocks very well. And that just, goes to show that I think they increased the resource by close to 1 million ounces last year through drilling very minimal holes. They knew where to target the different parts of the ore body, and ultimately created that larger resource. And yeah, you're right. There's, everyone on the board of directors owns shares in the business. Elaine herself and her management team as well. So I think they'll reward themselves as well as shareholders over the next few months, and if not years. And ultimately, I think if this company does get the operation up and running, they won't be trading at $3 an ounce. They'll be trading at multiples of where they are today.
So what's their long-term strategy? Is it to develop it out the asset, or is it to end up selling to a larger producer?
Mm-hmm. I think their plan is to develop it themselves. Of course, any company, if they get the right offer, will consider that offer and potentially sell. I do imagine if they got a good offer, they would, especially given where they're trading at right now. I could imagine a company coming in and giving them an offer that would be, again, multiples of where the price of the company is right now. And they would likely take that. Of course, there's a lot of hurdles to get operation back up and running. Like I said, the permits, going through the different economic studies, PEA to feasibility study, and so on. But again, they have to progress with the mindset of building this into a fully operational mine, and they're doing so right now. So if that bid does come along, great. If not, they're going through all the right steps right now.
Are there any large gold producers in Guyana right now that could be their acquirer?
Not really in terms of producers. Reunion is a gold exploration / development company, just like OMI, and that they traded about a 400 million market cap, which is multiples of what OMI is trading at, and yet they have a resource that's smaller. They're also a harder. Their project is in a more rough area, harder to get to, in terms of there will be a lot of costs associated with getting the infrastructure to site to build that operation. But it's become an institutional story. So they're covered in terms of research by a bunch of different sell-side banks in Toronto. And quite frankly, there's very little difference in terms of the resource. In fact, I believe the OMI Gold's resource is more attractive. And it's also a lower risk, given they had this previous operation. They know the metallurgy, they know how to mine it, and they have great relationships with the government. So that is a peer to sort of look at. And if you're to compare the two, you'd see a lot of similarities except for the share price. And so that, again, is where you can get the sort of value on these small cap miners.
Yeah. Okay, very cool. All right, guys, let's leave it there. So, how can everyone find you if they're interested in seeing your coverage and a little bit more in-depth reports on the names you just spoke about?
Mm-hmm. Yeah, so we have our website. It's atriumresearch.ca. On there, you can find all of our research from our thematic pieces, like Nick mentioned, as well as our research coverage on our covered companies. You can see every single research report on all of them. I think we've probably got 30, 40 research notes out there right now. And you can also follow us on Twitter as well as LinkedIn. And then lastly, we just recently launched our YouTube channel where we do management interviews with different management teams of some of the companies that we've mentioned here.
Okay, very nice. Yeah, we'll leave a link to that in the show notes as well for anyone interested.
Great. Thank you.
All right, guys, really appreciate the time. We'll catch you on the next one. See everyone.
Thanks, Cam.
Thanks, man.